and get started. Again, this is chapter 5, inventories. I'm going to go ahead and share my screen with you. Today we will go over the theory and the reasoning behind chapter 5, and then next time on Wednesday we will be working problems. So as always, let's go to Blackboard, the lessons folders, and then find the PowerPoint presentation for chapter 5, inventories and cost of sales. So you'll notice that because this is kind of a complex chapter, I've already recorded problems for chapter 5, and these problems are included. There's some of the problems in the in-class practice set. So for those of you who like working ahead, you can actually look at these 2 recordings. They cover 4 problems, and they will help you understand the material a little better. But for the time being, we'll go ahead and open the chapter 5 PowerPoint presentation. And let's talk about inventories. Some of the material today will be familiar to a certain extent because of chapter 4. And that would help out quite a bit, actually. So our goals for the day, we'll learn how to identify inventory items, what belongs in inventory. So one of the common mistakes students make is they think that supplies, for example, belong in the inventory account, but that couldn't be further from the truth. Inventory items are items the company buys with a specific reason of selling to their customers later. The other thing that we'll learn how to do is we'll learn how to figure out what the cost of inventory is. So in chapter 4, we talked about transportation costs. We talked about purchase discounts, purchase allowances, and purchase returns. So we'll continue along those lines in chapter 5 as well. So we'll really learn how to compute the cost of merchandise inventory. In addition to that, we will look at the 3 different inventory valuation methods, LIFO, FIFO, and the average cost method. And we will learn how to compute the lower of cost or market when inventory is overvalued or overpriced. So let's look at a few things that make up the cost of inventory. Merchandise inventory, going back to chapter 4, we talked about the inventory is a current asset account. We expect to sell the inventory items fairly quickly. We expect to convert inventory into cash as soon as we possibly can. Merchandise inventory, as I mentioned earlier, is all the merchandise or all the product or all the goods that a company owns and holds for sale, regardless of where the goods are located when the inventory is counted. So let's look at Walmart, for example. They have thousands of stores worldwide. They have thousands of warehouses worldwide. In addition to the goods that are located in their stores and warehouses, they have goods in transit. We've seen all those 18-wheelers with Walmart's logo all over the country. So goods in transit have to be counted in the company's inventory and included in the company's inventory value if the company has the legal title to those goods. So goods in transit is a special item because those we have to determine whether or not those goods belong to the company. Some other special items that we'll talk about today are consignment goods and goods that are damaged or obsolete. So when we calculate the value of inventory, we need to look at the transportation costs. And we need to determine whether or not the goods in transit belong to the buyer or they belong to the seller of inventory. So FOB shipping point, FOB stands for free on board shipping point, means that the legal title of the goods that are shipped is transferred from the seller to the buyer at the time of shipping. So as soon as the seller loads the goods they sold to the buyer on the public carrier, whether that's trains, planes, or automobiles, those goods become a part of the buyer's inventory. So this is what you need to remember for FOB shipping point. The goods are included in the buyer's inventory as soon as those goods shipped. However, FOB destination is different. FOB destination means that the ownership or the legal title of the goods sold exchanges hands. It transfers from the seller to the buyer when the goods arrive at destination. So if the goods are in transit and the shipping terms are FOB destination, those goods should not be included in the buyer's inventory. They become the buyer's goods or product once they arrive at destination. So these are all very important issues in counting and valuing goods that are part of the buyer's inventory account. So this was the first special item. Let's look at the second. The second special item are goods on consignment. Goods on consignment always are counted in the inventory of the owner. So the owner or the consignor, they have to include goods on consignment in their inventory account. Once they are sold and they don't belong to them anymore, they become cost of goods sold. The third special item, when we determine what belongs in the company's inventory and what doesn't, is goods that are damaged or obsolete. So if goods are damaged to the point where they cannot be sold, if goods are obsolete to the point to where they cannot be sold, they should not be reported in inventory. So if we have damaged goods, if we have obsolete inventory, the value of those goods need to be taken out of the inventory account and written off as an expense on the income statement. There may be damaged goods or obsolete goods that can be sold for a lower price. So if we have those damaged goods that can be sold, then we need to figure out what the net realizable value of those goods is and determine whether the company will take a loss for damage or obsolescence. So when I say a loss associated with damage or obsolescence, that loss appears on the income statement and it lowers the company's profitability. So out of these three items, goods in transit, slide 5, goods on consignment, slide 6, and goods, damaged goods or obsolete goods. We really do need to worry about goods in transit the most because goods are being shipped all the time. So the company has to be able to figure out the accurate levels of inventory and the accurate inventory value. Goods on consignment, for the purposes of this class, we're not going to deal with those a whole lot. I just wanted you to know what that means from an accounting perspective. And then goods that are damaged or obsolete, we will actually look at the lower of cost or market method on Wednesday, and we'll learn how to write down the value of inventory to account for goods that are obsolete. So let's look at what do we do to determine the inventory costs. So the first several slides, we were exploring and we were trying to determine what product is included in inventory. But now we'll look at the dollar value of inventory and what becomes a part of inventory. So let's say Walmart orders water from Pepsi Cola, let's say. Bottled water, they have a truckload of water coming in, and let's say that inventory, the product itself, costs $1,000. Now, the $1,000 definitely becomes a part of the inventory account. The generally accepted accounting principles allow some other costs to be included in the inventory cost. So the invoice cost is only the starting point when calculating the total inventory cost. So the invoice cost, or in my example, the $1,000 is the starting point. To that invoice cost, we will be adding some other costs. The cost of shipping, for example, will increase the value of inventory. The cost for storing the inventory items, insurance, any kind of duties, any kind of tax would increase the value of inventory. And if the company is given discounts and they take advantage of those discounts, inventory costs will go down. So again, the invoice cost, the cost of the product is only the starting point when calculating inventory value. All of these other costs need to be included because the company is allowed under the generally accepted accounting principles to lump up every single cost they had to incur to prepare their inventory for its intended use. And the intended use of inventory is selling it. So the inventory has to be brought into a warehouse or the store safely. Then the inventory has to be stored appropriately. So the costs of all of these items increase the inventory value. So inventory is one of the most valuable assets for a merchandiser. That's the reason why merchandising companies have developed strong internal controls over their inventory accounts. One of those internal controls is a physical inventory. So at least once a year, all the big retailers we're familiar with will take a physical count to see what is actually in their stores and at the warehouses. And when the physical count does not match the accounting records, adjustments have to be made. So physical inventories involve the counting, weighing, measuring inventory items, and applying inventory costs in dollars to them. So inventory, again, is one of the most valuable assets for a merchandising company because remember, the intent of the merchandiser is to turn inventory into cash. Inventory sometimes goes missing. Customer theft, employee theft contribute to significant reductions in inventory. So good internal control practices over inventory include pre-numbered inventory tickets, the counters of inventory, they have to be independent with no inventory responsibility, just so the company can trust that they will count inventory correctly. And there has to be independent internal verification. So another person, a different counter, has to perform a secondary count, and then the manager must confirm that all items are counted only once. So a few years ago, when I was working for Miller Coors, I was in charge of taking the physical inventory for the packaging department. The company took inventory super serious. So we would go out there and count bottle caps and labels in the millions. And one of the internal controls that Miller Coors had was that we would have to independently, internally verify that the counts are correct compared to what the accounting system stated inventory should be. And we had to find missing items because we were not allowed to have discrepancies between the physical count and the accounting system larger than $1,000. And you guys, you know how big Miller Coors is. So $1,000 is not very material, but the company put an emphasis on internal controls. They put an emphasis on understanding what's happening to their inventory because that led to lower costs and higher profitability. So let's talk about how inventory is costed. Again, today we will only look at these inventory costing methods. I'll talk to you about specific identification, first in, first out, FIFO, or last in, first out, FIFO, and the weighted average costing method. And then on Wednesday, we will be working some additional problems from the book. So there are four methods used to assign cost to inventory and to cost of goods sold. You may be wondering, why do we need a method? Inventory costs what inventory costs. That may be true if you were a small business and as the business owner, you knew every single unit of product bought and every single unit of product sold during the accounting month. Well, that's not true when it comes to large retailers. So they, from an accounting perspective, they had to come up with some assumptions or some costing methods to determine what inventory is and what cost of goods sold is. Most US companies use first in, first out. As you can see on the pie chart, 48% of US companies use FIFO. And one of the reasons why they do that is because FIFO is simply a good business practice. First in, first out, if we look at the physical flow of inventory, is desirable for any company. The first items purchased should be the first items sold. But remember, this is an accounting class, so what we're looking at has nothing to do with the physical inventory flows. This is just an accounting assumption. So another 28% of US companies use LIFO, last in, first out. This assumption, again, this is an assumption that we make to assume that the company sells the last items they purchased first. Again, this has nothing to do with the physical flow of inventory. We just make an assumption from a costing perspective that the company sells the most currently purchased units. And then the weighted average, about 20% of US companies use that. The weighted average is really simple to use. That's probably the biggest reason why companies do it. And it smooths out pricing differences. So we will be looking at first in, first out, last in, first out, and weighted average. But before we do that, let me remind you something that we learned in chapter 4. Remember, when we are working with inventory, in the inventory account, we will always have a beginning balance unless the company literally started their business operations today. To the beginning balance, we'll add net purchases. And remember what net purchases are. Net purchases are gross purchases minus discounts, minus returns, minus allowances, plus freight. The sum of the two is what we called in chapter 4 merchandise available for sale, or inventory available for sale, or goods available for sale. Once we have that calculated, if we are given the ending balance in inventory, we can simply calculate the cost of goods sold. So if we know how much we had available for sale and how much is left, then the cost of goods sold should be the difference. All right, so let's look at the inventory costing under the perpetual system, and then we'll start exploring FIFO, LIFO, and the average cost method. So there are two inventory systems. We will be spending today most of our time on the perpetual inventory system. The perpetual inventory system is the system where every single time the company buys or sells inventory, the accounting records are updated real time. So the inventory, when we buy inventory, the balance sheet is affected. When we sell inventory, the income statement is affected. So inventory touches both financial statements. So inventory will increase the balance sheet, the asset parts of the balance sheet, when inventory is purchased. At the end of the month, we are concerned with reporting the accurate ending inventory on the balance sheet. And then again, as inventory gets sold, on the income statement, cost of goods sold will be increasing, which in turn decreases profitability. Remember, when it comes to inventory costing, the physical flow of inventory does not need to follow the accounting flow of inventory. So let's look at first in, first out. You probably already noticed that I'm skipping specific identification. I'm skipping specific identification because that method is really not usable. It's not friendly for the big publicly traded corporations, merchandisers that we're talking about in this class. Specific identification method only works if the company has very few items of inventory. So let's start with the first in, first out. It literally means the first items the company purchases from a supplier are the first ones to be sold to their customer. So under the first in, first out, the cost of goods sold is based on the oldest costs. The cost of ending inventory is based on the most recent costs. And it makes sense, right? Look at the cost of goods sold. First items purchased, in other words, the oldest items, will be the first ones to be sold. So on the income statement under cost of goods sold, we will see the oldest inventory costs represented. On the balance sheet, though, ending inventory will be comprised of the most recent costs, because when you really think about it, if we are to sell the oldest items, then the most recent items, the most current items, the newest items will be left in the ending inventory account. So let's look at an example. Under the perpetual system, we will be accounting for every purchase, every sale as it happens. So in this case right here, the very first line item is the beginning balance. This chart tells me that as of August 1st, the beginning balance was made up of 10 units. Look at where my cursor is, 10 units. Each unit cost $91. This unit cost is what the company paid for the inventory items. So again, in the beginning balance, the company has 10 units at $91. The total value of inventory as of August 1st is $910. Now look at August 3rd. what happens here on August 3rd? They purchase another 15 inventory items, but look at the price. Now the price is $106 per unit. So is this normal? A lot of times this is very normal. The inventory prices are going up. Look at how the oldest items here, the items in the beginning balance, have a lower cost than the newest items that have a slightly higher cost. So now, if I look at the inventory balance right here where my cursor is, I can see the inventory now is comprised of 10 units that the company purchased in the past at $91 per unit, and the newly acquired 15 units at 106. On August 14th, where my cursor is, right here, the company sold 20 units of product. So now is when first in, first out becomes relevant. Now the question becomes, if the company sold 20 units of product, which ones are they? Under first in, first out, again, the assumption is that the company will sell the oldest units first. And you can see right here that they're selling all 10 units at $91. In addition to that, 10 of the most currently purchased units at $106, which makes the ending inventory balance on August 1st the 5 units remaining at $106 per unit. So again, and you'll see in the recordings, if you guys want to listen to those recordings early on, you'll see in the recordings that when we are working problems like that, we take it step by step. We do it very slowly. We need to account for every single unit purchased and every single unit sold. At the end of the day, our goal is to calculate the total cost of goods sold that the company reports on their income statement, which is this number here, and the ending inventory balance, which they report on the balance sheet, which is this number here. So remember that this is FIFO, first in, first out. Cost of goods sold is based on the oldest costs. In this case, the oldest costs happen to be the lowest. So if cost of goods sold is based on the oldest costs, which happen to be the lowest, then the cost of goods sold on the income statement will be the lowest and profitability will be the highest. Let's see, I heard a question pop up. Can I zoom in a little bit? Yeah, I'll be happy to. Let's see. Okay, so you guys can zoom in if you want to. I can do this so you can see it better. So whatever works. All right, moving on. LIFO, last in, first out. This is on the other important, remember 28% of all US companies are using this method, so we need to be familiar with it at least. So last in, first out, the only thing that this method assumes is that the most current items will be sold first. So if we're assuming that the most recent or the most current items are sold first, then cost of goods sold, where my cursor is based on the most current costs, and then ending inventory will be based on the oldest costs. And it does make a difference when you think about it. So let's look at the same example, same form, last in, first out. These are the exact same numbers, and this is the example they use in the book. So remember, this is a company that has in their beginning balance 10 units at $91, where my cursor is. Then on August 3rd, they purchased 15 more units, the exact same scenario, right? As we move through time, we can see that the oldest costs are the lowest. We can also see the most current cost are the highest. Now, I want you all to look at August 14 right here, where my cursor is. This is the same sale. The company is still selling 20 units of product, but our assumptions have changed. We are now assuming LIFO, or last in, first out. We are assuming that the latest units, which is these 15 right here that the company bought on August 3rd, those are the units that the company sells first. And look at how it changes cost of goods sold and ending inventory. If I make the assumption that I sold the latest units where my cursor is first, so I'll have 15 units at 106 and 5 units at 91. So remember this number, $2,045 cost of goods sold. I'm going to scroll up a bit, slide 19. Here's the same slide. Look at the difference in cost of goods sold. Changing the assumption gives us a different answer. And if prices are going up, see how prices are going up, $91 to $119? If prices are going up, then FIFO will give us the lowest cost of goods sold because we are using the oldest and cheapest products. And then I'm going to go back to slide 21. LIFO will give us the highest cost of goods sold because we are using the highest costs of product purchased. So LIFO and FIFO will give us very different answers. In periods of rising prices, you can see how the prices are going up here. In periods of rising prices, FIFO will give us the lowest cost of goods sold, and LIFO will give us the highest cost of goods sold. So these are the two assumptions, inventory valuation or inventory costing methods. The third one that we are going to look at is what's called the weighted average inventory method. So the weighted average, basically what we do here is rather than looking at which unit was sold first, which unit was sold last, what we need to do is we calculate an average cost of each unit in inventory. So we'll take the total cost of goods available for sale. That was the reason why I showed you the slide from chapter 5 a little earlier on. And we divide that by the units on hand on the date of the sale. So this is just a weighted average calculation. Once we figure out the weighted average cost per unit, then we can apply that weighted average cost to the units sold to figure out what the cost of goods sold is, and to the units remaining in inventory to figure out what the ending value of inventory is. So here's the problem from the book, and it's a very busy slide. So I think when I work the problems in the in-class practice set, it would be a lot better and you'll see it a lot clearer. So for the weighted average, we are, here is the same example, right? The beginning balance is 10 units at $91. Then they purchase more units. So on August 14, when 20 bikes are sold, we need to determine the weighted average. Remember that the formula is the cost of goods available for sale on that day divided by the units available at that time of sale. So let's see what the units available are. They have 10 units in beginning inventory. They're buying another 15, right? So they have 25 units available to sell at that point in time. The cost of goods available for sale is $2,500 because the cost of the first 10 units is 10 times 91, 910. The cost of the purchased units is 15 times 106. The sum of the two is 2,500 units. Did you guys have a question? Babajide, you are welcome to stay after the lecture for chapter 5 is over, and then you can ask me all the questions that you're confused about. Okay, so any questions on the weighted average? All right, so moving on, or actually before we move on, let's see. Okay, let's look at some other things here. For the weighted average, once we compute cost of goods sold, we'll use the weighted average to compute cost of goods sold and the value of ending inventory. When it's time to do that for the next sale, we'll do exactly the same thing. We'll look at the cost of goods available for sale and divide that by the units available for sale at that point in time. Again, we will practice some problems. A lot of you will find this chapter quite confusing, frankly, so please listen to the recording of the 4 problems that's already available to you. So there the implication, the choice of inventory valuation method it brings some implications for the financial statements that you guys need to understand as well. So if you choose first in, first out, well, before I talk about this, let me tell you that companies are allowed to choose their method. They can go back and forth. They can use first in, first out. They can, next period, they can use last in, first out, as long as they disclose it, right? But the choice of method has quite a bit of implications on the financial statements. So if they choose first in, first out, the ending inventory on the balance sheet will be super accurate. It will approximate the current replacement cost of the inventory. Last in, first out, the cost of goods sold will be super accurate because cost of goods sold on the income statement will approximate the current cost of inventory. And then the weighted average, it's just nice because it smooths out price changes. Earlier, I told you guys that every method will give us a different answer. So in a period of rising prices, you can see it right here. Cost of goods sold under FIFO. Remember, we're ignoring specific identification. So FIFO will give us the lowest cost of goods sold, LIFO the highest, and then the weighted average is right in the middle. Well, look at the net income line right here. If FIFO gives us the lowest cost of goods sold, that would result in the highest profit. LIFO will have the lowest profit, and then the weighted average will be right in the middle. So again, this only works when the prices change and the prices are going up. A couple of other things, and then I'll let you guys go so I can answer Babajida's questions. Obviously, if we lower profitability, then that has effect on the income tax. So IRS requires that when the company uses LIFO for tax reporting, they also have to use LIFO for financial reporting. We call that the LIFO conformity rule, and you guys are not responsible for any calculations that involve the LIFO conformity rule. You just need to know that it exists. All right, in addition to that, the company is required to report inventory at market value when the market value is lower than the cost. So next time, we'll be working some problems that involve the lower of cost or market. And we will see that if we have obsolete inventory, which happens more often than you think when the inventory is comprised of technology items, we lower the value of inventory and we also increase the cost of goods sold on the income statement. A couple of other things from chapter 5 that you need to be familiar with. You need to know that if the company makes an inventory error that affects both the balance sheet and the income statement. So slide 36, especially when you guys are working problems, is a very useful cheat sheet for you when trying to determine whether an inventory error overstates or understates the balance sheet and the income statement. So that's all I have for today. Please look at the recordings online. And then when you come back Wednesday, I'd like to address any questions that you might possibly have that are related to chapter 4 and 5, because remember, chapter 4 also touches a little bit on inventory, so we're using some calculations from chapter 4. Next time, we will also discuss the inventory turnover ratio and the days of inventory, days in inventory. So we'll learn how to perform those two calculations as well. Do you guys have any questions at all? I'll be happy to answer whatever you have for chapter 5. If you don't have anything for chapter 5, then Babajita asked me questions for chapter 4.